Alright everyone, Cowboy Trades here and welcome back to the channel for another update on the stock market. So history looks like it's about to repeat on the SP500. So what we're going to do today is we're going to look and take a deep dive into the three major bear markets in the past 25 years that were predicted by the yield curve. These were of course the major bear markets and recessions in the year of 2000. 2008 and also what we're seeing right now in 2022 bleeding into 2023. We're going to take fractals of each of these bear markets, overlay them with what is happening right now, compare the cycles, and then also talk about how key market conditions like the unemployment rate and the federal funds rate affected the financial crises and if we're seeing something similar at this moment in time. So let's of course dive through in logical order. Let's start off with the first recession that was predicted in the past 25 years by the yield curve. This was of course the major financial crisis in the year 2000. This was your tech stock bubble. Now, first of all, let's just take a brief overview of the fractal. What I've done is I've gone back in history, looked at how the S&P 500 performed in the year 2000, and we've copy and pasted the data and overlaid it with what is happening right now in 2023. So what happened in the year 2000 is overlaid with this yellowy beigey color, and what is happening right now in 2023 is obviously these red and green candlesticks, and this will be the same when we're looking at the 2008 fractal as well. So when we do look at what happened in the year 2000, you can see there is a strong correlation between the two. Now, often the peaks and the lows did not follow exactly. Of course, every bear market is going to be slightly different, but you can see the general trajectory of this financial crisis was lining up beautifully with what we're currently seeing right now in 2023. And you can see, according to the 2000 financial crisis, if history is going to repeat and we're going to follow this fractal, we could expect another meltdown coming into roundabout July of 2023. Now, the 2000 financial crisis, the tech stock bubble, this was absolutely brutal because you can see if this is going to play out, this may continue bleeding into, May of 2024 and double bottoming round about July of 2024. Now, this isn't my favorite stock market fractal to compare with what is happening right now in the 2022 to 2023 bear market. So I'll show you my favorite one, and this is of course the 2008 fractal. And after we're done analyzing what happened in 2008, we will go through and look at the individual market conditions of the 2000 and 2008 bear markets and talk about how these financial conditions were similar to what we're witnessing right now. So if we do come over to the 2008 fractal, obviously, once again, bear in mind we've retroactively fit the top of the data that was traded in the 2008 financial crisis, and you can see this one lines up beautifully. Once again, retroactively fit the top, but lows and highs, lows and highs, lows and highs were beautifully called over on this fractal. Now you can see there was a low called in December where we were going to be witnessing about a 1 or 2 month bounce on the S&P 500 before melting down. But what you can actually see is in December of 2022, we started to diverge from what happened in 2008. Market conditions are slightly different with what we're seeing right now than in 2008, and we'll discuss that in just one second. But more or less, these fractals have beautifully followed, and bar this one data point, we've been beautifully following this fractal. Now, you can see that we are kind of starting to move down in the same direction that the 2008 fractal was predicting, and if we're looking and forecasting where the bottom of this recession bear market could be, according to the 2008 fractal, we should be expecting lows to start coming into place round about the 30th of May, which is approximately 78 days away. This is a lot more conservative than what we saw in the 2000 financial crisis, where it could be another 420 to 497 days. Now, bear in mind, tech stocks and your cryptocurrencies, things like Bitcoin, altcoins, they're more likely to bottom with risk on assets during this low rather than where the S&P 500 bottoms on this low, which is a couple of months later. The reason for that is because no one's going to be rushing in to buy the S&P 500. No one's going to be like, I have to buy McDonald's stock now, I have to buy Apple now, I have to buy Nvidia stocks now. People are going to be like, I want to buy Bitcoin now. This is going to offer high yield returns. I want to buy into the NASDAQ right now, things that are going to offer, much deeper returns. People can buy the S&P 500 whenever they want, sit on it for 20 years, and then they'll make some gains. No one's rushing in to buy the S&P 500. A lot of people are going to be rushing in to buy risk assets. So when we're looking at this, in my opinion, if you're wondering when things like the Nasdaq and cryptocurrencies are likely to bottom, it's much more likely to be on this data point around about here. You could also look at this low forecasted around about 112 days away. So either way, both of these fractals in the next 80 days and the next 100 days or so are predicting that we should be having another melt back down to the downside for these markets. Now, we've obviously looked at how 2022 has been trading. We've been doing a lot of analysis on this on my channel. Of course, you can see the 2000 fractal is following quite well. The 2008 fractal is following much better. So now let's take a deep dive into financial conditions. Let's look at exactly what was happening in these bear markets with the unemployment rate and the Fed funds rate in the years 2000 and also in the 2008 bear market, and talk about how these are similar with what we're witnessing right now in 2022 and what that could mean for the next move for the markets. Once again, going in logical order, let's look at what was happening back in this period over here where the yield curve was predicting this major recession in the 2000 financial crisis. Well, what you can see is the bear market started right around here in March of 2000, but we continued to absolutely melt down until about October of 2002. So this was round about just over a 2-year bear market for the markets. And what you can see with this is when the markets were topping out, it was because the interest rates were becoming extremely expensive. The Fed funds rate was shooting up. Obviously, the Fed funds rate has a direct correlation to what domestic banks are going to be offering for their interest rates if you're holding money with them, if you're borrowing money from them. If the Fed funds rate is high and it's going up, then that's going to bleed into what happens with domestic banks. And domestic banks are also going to increase their interest rates for people like me and you who are either lending money, putting money in savings accounts, or whether we're borrowing money from them. The Fed funds rate is going to have a direct impact on these other banks. So what you can see is the Fed funds rate went up and up and up, and when it topped out round about in the 2000 tech stock bubble, it topped out round about 6.5%. And you can see, we were rolling down. A lot of your tech stocks were getting obliterated compared to the S&P 500 back then. But you can see right here, the Fed started to lower their interest rates. And this is a common misconception that I see all of the time on the markets. A lot of people are waiting for the Fed to pivot. They're waiting for the Fed to lower their interest rates because they think the second that the Fed come out and say, hey, we're pausing interest rate hikes, or they think, if the Fed come out in a couple of days or so when the next FOMC is, they think, hey, if the Fed lowers the interest rates by 25 basis points, 50 basis points, 75 basis points, they think that that is going to be where the bottom is. And that is historically absolutely inaccurate. You can see bounces have proceeded, maybe about 10% for the stock market. Maybe if you're in the cryptocurrency markets, that could be a 30-40% rally after the Fed cut their interest rates. But you will see, looking at what happened in 2000 and 2008, that the Fed cutting their interest rates, it takes a very, very long time to come back down to cheap levels of credit. And the markets right now are often rallying on the hopes that the Fed are going to be lowering their interest rates. Now, what happens if the Fed do lower their interest rates? Well, we still have expensive credit. It will still take ages to come down to cheap levels of credit. And then what can the markets rally for after that point? If the Fed do start cutting their interest rates, then the markets will price that in. And then what other bullish news do we, or quote unquote bullish news, what other bullish news do we have to price in for the markets after the Fed start cutting their interest rates? Well, nothing. There's nothing left to the bullish picture apart from, hey, in a year or two, interest rates might be cheap again. And that is a long way away. So as you can see, once the Fed started cutting their interest rates, the markets actually continued to melt to the downside for a very long time. And when the Fed started cutting their interest rates, we obviously had high interest rates for quite some time. And high interest rates, it takes a while, but it will bleed into the unemployment rate. The higher the interest rates go up, then the less that businesses can borrow to expand their base of operations. Let's say if you're Apple and you want to build, new facilities, you want to build a new shop in this mall, you want to build a new shop in this mall, you're going to need money to do that. You might borrow that money from the Fed, you might borrow that money from the bank. whatever you do, if you've got cheap credit, you're much more likely to create a new business, create a new shop, and with that, you'll need to hire more people. If the interest rates are high, you're not going to do that. So typically less people are employed when the interest rates go up. And like I said, it takes a while. So once you come up to these high levels of interest rates, it is very likely to then later bleed into the unemployment rate as more people become unemployed. Now, what did we need to see for this bottom to take place? Well, as you can see right down here, we needed cheap levels of credit and we needed the unemployment rate to pretty much top out. Now, we actually bottomed for the S&P 500 back in the 2000 financial crisis when the unemployment rate was at 5.7%. Now, the markets were pricing in this top at 6.3%, so they were saying, hey, you know, the unemployment rate may not have topped, but it is pretty much topped, and I'm not going to wait for the unemployment rate to go up, you know, another 0.5% before I start buying. So the market started pricing in a top in the unemployment rate. You can also see the Fed funds rate didn't quite bottom, but they were saying, hey, we can now get credit for 1.7%. We might as well start buying now instead of waiting for credit to be down here at 1%. So once again, they were saying, hey, interest rates may not have bottomed, the unemployment rate may not have topped, but we're very, very close to this market situation. So we're going to start pricing in what is happening next with the unemployment rate and what is happening next in the interest rate. So this is what we needed to see for the 2000 tech stock bubble to bottom. We needed high unemployment rate and we needed a bottom in the Fed funds rate. Now, let's go over to the 2008 financial crisis. Do you think anything differed? No, not really. So what happened is you can see the stock market topped out round about here, and this was just after the Fed started cutting their interest rates from extremely high levels. Now, what happened when we had these high interest rates? Well, once again, you can see after you were at elevated levels of interest rates, you can see the unemployment rate started slowly itching up. Like we said, the unemployment rate is a kind of like a lagging indicator of the Fed's funds rate. If the if the Fed funds rate skyrockets, it will take maybe 6 months, maybe it will take a year, maybe it will take 2 years for that cheap credit to run out, that cheap lines of credit. But once again, once it does, you will start to see that bleed into the unemployment rate as it does go up. So look, we talked about the backstory of this in the 2000 financial crisis. So let's just look at what was required for the 2008 bottom to be in. Once again, a lot of people were saying, hey, as soon as the Fed start cutting their interest rates, then the bottom will be in. That was not true. The Fed started cutting their interest rates and it caused this massive meltdown to the downside as the economy was showing major weakness. And you can also see that bled into the unemployment rate. So what was required for us to bottom in the 2008 financial crisis? Well, let's look. We bottomed round about here in March of 2009. Let's look at where the unemployment rate was. The unemployment rate was up here at 8.74%. We topped out at 10%, so basically a 1% difference. And what happened with the Fed funds rate? Well, the Fed funds rate went down to historic lows at 0.26%. Extremely cheap lines of credit flew into this market. And we've been talking about obviously how right now we're currently witnessing a credit crunch, which is not what you want to see for the market's growth. You can see when the unemployment rate is high and the Fed funds rate is low, this is typically the signs that we see when a bottom is forming and we're at the worst stage of financial health. And obviously, you know, at some point that will pivot back around, and that's what the markets start pricing in. So while the unemployment rate was just underneath 9%, we topped out at 10. And you can see people started buying at 9%. So what the markets were saying is, hey, we're basically at 9% now. The unemployment rate may go up to 10%, but after that happens, I do think the market's health will start to return. So what happened? People didn't wait to buy when the unemployment rate topped out. They started to buy around about 9% just before it topped out. They were saying, hey, if I buy now before the unemployment rate tops out, you know, I can already get these cheap lines of credit. I may as well take the risk of one more small move to the downside so I can potentially buy the generational lows. And that's what happened. People started buying, forecasting that next move up to be the top for the unemployment rate and forecasting that the interest rates were cheap enough for them to enter the market. So This is what we needed to see. Nothing changes when you're looking at these financial crises. If you've studied economics, if you've turned up to the first lecture, you know Economics 101. Cheap credit is required for a bull run, and expensive credit is often what causes these cascades, also known as credit crunches. We did a in-depth video talking about this S&P 500 credit crunch the other day. So what did we need to see in the 2000 financial crisis, and what did we need to see in the 2008 financial crisis for markets to bottom? We needed a high unemployment rate. We needed low Fed funds rate. You can see it's the same picture when you're looking at these bear markets. So what is happening right now with the 2020 bear market? Well, the labor force is still extremely strong. The unemployment rate is actually at very, very low levels. I mean, we were at 3.4% and it started to turn up the other day after Powell's speech, where Powell started signaling, you know, really the only way that we can start pivoting in the interest rates is if we keep on raising the interest rates, and then unemployment needs to come up, which will help lower inflation. A weaker job market will help, you know, lower these levels of inflation, and then eventually we can start pivoting back into cheap financial conditions. We've obviously covered this over on the channel. We had some senators talking about how, you know, 1 in 10 Americans could be out of work on this. That would be a 10% unemployment rate, just like we saw in the 2008 financial crisis, but the job market is still strong. We're down here at an unemployment rate of 3.6%, and the Fed has not even started cutting their interest rates. So the notion that the stock market, the cryptocurrency markets are just going to explode to the upside when unemployment is at historically low levels and the interest rates are extremely expensive. I mean, how are we going to start a new bull run when credit is this expensive? If you're looking back in history, expensive levels of credit creates these bear markets, and cheap levels of credit is what starts these bull runs. So I think a lot of people who are predicting for the bottom to be in haven't studied economics. They don't have an economics degree. They haven't turned up for any economics lectures. They simply look at trend lines, and then maybe one day they say, hey, you know, we've broken out of a trend line, the bull run is coming. If you're looking a little bit more in depth, if you're looking at these market conditions, it is not in agreement with what is happening right now. And also I see a lot of talk about quantitative easing right now. I'm going to make a separate video about this. We're currently not seeing quantitative easing, but some people are saying the Fed is going to start printing money. We're going to start bailing banks out, because we've also quite recently seen that Silicon Valley Bank was bailed out. Now, a lot of people are saying, hey, if we start bailing these banks out and the money printer returns and we start printing money to bail banks out, that is bullish for the markets. Anyone who thinks that, I really suggest that you go and look at what happened in the 2008 financial crisis, because we saw quantitative easing estimated between 200 and 500 billion in the 2008 financial crisis. And people right now are saying that banks going bankrupt and the Fed being forced to turn the money printer on to bail these banks out is bullish for these markets. That is absolutely, completely inaccurate. If you look at what happened in 2008, once again, there are different estimates from different economists. If we look at CNN, they're estimating 200 billion. We covered this the other day on the channel, and we looked at other estimates, around about $500 billion in other estimates. And you can see all of these banks that got bailed out. Wells Fargo, a $25 billion bailout, you know, $2 billion bailouts, 15 billion, 25 billion, 25 billion, 10, 3, 3.5 billion. We saw so many of these bailouts that were paid. The taxpayer had to pay for most of these. And of course, this was mostly quantitative easing that bailed these banks out. And now people are saying that if the Fed starts to turn the money printer on to bail banks out, that is what is going to create the next bull run. But history categorically states that that is absolutely not true whatsoever. So there we go, my friends. I do believe history is about to repeat for the S&P 500. With Powell's most recent speech, he talked about how the interest rates need to go higher. This is going to cause the unemployment rate to turn up. That is just the unfortunate fact of the matter. He said we're not targeting high unemployment rates, but we're targeting high interest rates, which will unfortunately create higher levels of unemployment. And that is really the only way out of what is happening right now. So do I think anything has changed? Looking at history, do I think that we're going to bottom on expensive levels of credit? No, I don't. Look at what happened historically. Whether you're looking at 2000, whether you're looking at 2008, the unemployment rate needed to go up and the Fed funds rate needed to go down. We needed cheap lines of credit before the markets were ready to rally. And that is why I believe history is about to repeat for the S&P 500. I believe the interest rates have a slight ways to go up higher. And even when the Fed start to cut, if history is any indication, the Fed cutting the interest rates does not mean that a bull market is right round the corner. In fact, it means that the markets would have finally priced in that final bullish event, and then they have nothing bullish left to price back into these markets. For today, my friends, that's all I've got. History looks like it's about to repeat for the S&P 500. Let me know down below, what do you think about this? Do you agree? Do you disagree? If you disagree, let me know why. But yeah, for today, like I said, all I've got. If you do enjoy my content, let me know down below by leaving a like and a comment. Share the videos with your friends. If you want to further support the channel, you can click join and become a member today. But 3 ways to help the channel are just leaving a like and a comment. This really does help with the YouTube algorithm. If you want more of my content, check me out over on Twitter at 618_cowboy. But yeah, see you in the next one. It's been your boy Cowboy Trades. I'm out. Peace.